is presented by FactSet, financial data and analytics powered by tomorrow. Special drop of the market call on a Friday. I think this is the last business day in the month of September. It goes by like this. It's incredible. Moving into October, that would be letter V for you playing our home game. Dan Nathan, we got Carter Braxton Worth. How are you doing, Dan?
I'm doing great. We thought that it would be fun to kind of catch up on the last day of Q3. And, it's been an amazing year in the market. Guy, you and I have been showing up every day on the market call, on the tape, CNBC's Fast Money, whatever, all the stuff that we do here. And it's funny, like the direction of the market. And we talked about this a bunch on Market Call, Guy, that it's reminded us a lot 2023 of late 2021, at least in this environment, right? Because I'm looking at the S&P on the year up 12%. I'm looking at the NASDAQ up 26%. I'm looking at the NASDAQ 100 up a lot more. We know that month to date to September was not particularly great. The S&P right now is down 4.5% on the month. The NASDAQ is down almost 6%. That's a big monthly move, especially on a year where we've had big gains in the major industries. So you and I thought, let's take a little stock of Q3. Let's talk about the sell-off. I think at the S&Ps at its lows this week was down 8% from its highs recently. And let's kind of like really zero in on a few charts, on a few kind of risk assets that we think could dictate the path of equities in Q4. And so we wanted to focus on energy. You've been all over this XLE and the OIH and the crude trade. Carter's had some great calls in yields. And then we wanted to take a look at the US dollar because we think that those three things, Guy, you agree with me, are really going to dictate how the S&P closes from here over the next 3 months of this year.
I think we've said it, rates hold the key for everything. And then obviously rates control what's going to happen with the dollar to a large extent. And energy seems to be its own animal, but energy is important because that's going to tell the tale for inflation and what the Fed is sort of forced to do moving forward. So those three things, there are other things that are important, clearly. we could look at technology, we could look at some individual names, but in the aggregate, those three names make the most sense.
Yeah. So let's bring Carter Braxton Worth. Carter, we really appreciate you being here with us on a Friday afternoon, worth charting. And I will say that one of the reasons why I really wanted to kind of turn the cameras on and the mics on today was because you had two really great notes out this week, one on the Dixie on the US dollar index and another on yields. But let's first, before we get to those, let's look at the S&P 500 because, you like to use that term to the penny. It seems like everyone else, we just rip you off, brother. But we have the S&P chart. We have that uptrend. We have that 150-day moving average that you like to speak to. It kind of did what it needed to do, the S&P 500 over the last month and a half, working off some excess. Talk to us about this chart really quickly and what you're expecting from here in the S&P 500. And to be very frank, this is Guy and my chart that we made, but we tried to use your 150-day.
Sure.
Tried to guess that uptrend that you would have used.
Yeah, and so you've connected the intermediate lows, two of them, to the October low. And of course, that is the trend line, and that is often where the 150-day moving average comes into play. And so now, and it is very hard, of course, do you buy it or not, right? So from its peak, we know the peak was 27 of July. Here we are essentially exactly 2 months later, 29 of September, but we're down 8% from the peak. And in fact, there are some stats and numbers around this independent of the chart, and they would be as follows. There have been 239 instances going back to the beginning of the S&P where you've got what is called a 5% plus sell-off, drop, decline, correction, plunge, you use your word. And the reason when we did our studies years ago on 5%, if a stock goes down 1% or 2% up, that's just noise. But something happens when you go down 5%, whether it's because stop losses are actually entered there and they start to get triggered, risk managers walk in and say, look, you're down 5, you got to start to take some measures, or it's just where the discomfort level starts. Once you go down 5 in the index, you typically go down more. And how much more is as follows. Basically, if you look at all 239, 1925 to present, 5% plus sell-offs, the average decline is almost 12%. The median is 8.25%. So we are right in line with the median here, having been down 8%. Typically lasts somewhere between 4 to 8 weeks. And this one is exactly 8 weeks. So in many ways, we can check off that box, both from a statistical point of view, that this is right in line with most 5% plus sell-offs. And we're also at a level of well-defined support, the 150-day moving average. But then there's this, and I'll end with this. The market is one thing, but the constituents is something else. And so if you look at the chart of banks, doesn't look like anything like this. It's a disaster. If you look at the charts of staples, a disaster. Utilities, disaster. And as you go through the parts compose the whole. The picture that we see here, the picture of the S&P, the picture of most aggregates, I think still is masking a lot of the underlying issues in the market. And the final way to describe that is we know that right now the Russell 3000, basically half the stocks in that index are actually not even up from the October lows a year, they're down. Remarkable.
1496, I think, was the number, because Carter and I did it the other day. And it's, today, as you mentioned, Dan, month end, quarter end, and it's 107. So there's some time left in the day. But I'll say this, given the early strength today, and then given the trend line that we drew and the fact that it held that trend line and bounced, given its quarter end, the acceleration to the upside that we saw late yesterday and early today should continue. Historically, when I say historically, over the last 5 to 10 years, that would have been, without question, write it down, that would have continued. It would have accelerated into the close. We're not seeing that today. Now, granted, there's some time left, but just keep this in mind. This late or this midday sell-off is noteworthy, again, given all the things that I just mentioned.
Yeah, no, that is exactly what I was thinking too, Guy. I mean, that looked like a beautiful, like kind of V bottom or a little like spike bottom reversal, Carter, when we had those lows yesterday morning, closing on the highs. You get a follow through, and you would like to see another 1% or something like that. We're not getting that. So it'll be interesting to see how it plays at your 150-day moving average and obviously that uptrend. So stay tuned, people. All right. So one of the fun things we wanted to do on this Friday afternoon, not only do we want to look at Carter's charts and some of the setups that we have from a fundamental standpoint, Guy, and my take, what we also wanted to introduce 3 trade ideas using options, defining your risk to kind of play these sorts of moves. I want to start, Carter, with your note that you had out on 10-year yields. I think you were on CNBC's Fast Money early in the week. You did a catching up with Carter a couple times on worthcharting.com this week. You thought head fake in yields, that reversal in the 10-year yield, that is the thing that got the equity market going a little bit to the upside yesterday. Walk us through what you're seeing in the charts here.
Well, so lines draw themselves, and those are mathematically parallel lines, those sort of lighter blue lines. And when we reach the upper band, the note was put out, look, we're up against the upper band. This is where you start to buy bonds, or at least head fake. I think it's going to not go higher. It did, actually. We went to 463 maybe, but importantly, we have reversed. We're back in the channel just from when the note was put out, I guess, earlier in the week. And so the question is this a head fake? Is it sort of peak? You've got everyone on one side all of a sudden, right? I mean, if you think about it, just go back to June, and oil was at $65 a barrel, rates were at 3.5, and it was hard landing recession. Now you go here and I was going to say liar for longer, but literally all these stupid phrases. I mean, they make up the phrases at the peaks. Nifty 50, they make that up, and that was the end of that. .com, it's whatever it is, something for longer, higher for longer. It's when you start hitting monikers and little bromides like that, it's important to basically, I think, go the other way. So I think everyone's anticipating higher yields, and I would say you buy bonds.
It's interesting. So this channel we looked at the other day as well, and I'm not splitting hairs here, but I actually think at one point we saw 10-year yields got up to like 468. I don't think we saw a 4.7 print, but the reversal is what's important. The reversal yesterday, I think we got the equity market moving. I have no idea why the reverse. It doesn't necessarily matter, but you saw a pretty strong reversal, and to a certain extent, you saw it as well today. I mean, I don't want to get too granular here, but I will say this. This channel could be intact. Yields could start to go dramatically lower, but that might be on the back of a market sell-off, which in fact is what we're sitting here watching over the last hour. So all these things make a lot of sense to me, Dan.
Yeah. So Carter, why did you choose also in your note to go back 20 years? I mean, like this is it just the wisdom of the long-term price action and the level in which we got to? You just think that when we look at these charts, it makes a lot of sense.
Well, what I did for the TLT was just use all data because the TLT hasn't been around that long, right? This is an all data chart of TLT as far back as it goes. And remarkably, let's do a little reveal. Look at this line. We can flash it, take it off, put it back, take it off. But I mean, so does it have to be as simple as that? Sometimes it is. Just a little sidebar. When I was starting out, I put away my Q's and K's and I started to be an apprentice to this old time technician, really my mentor. He said, Carter, if you can draw a straight line, you'll be okay in this business. And I thought, my God, he's making fun of me. He doesn't think I'm very bright. He just wants me to update his charts. He wasn't. He was completely serious. Just draw the goddamn lines. Anyway, look at these arrows coming on next. I mean, flash those. Let's take them away, put them back. I mean, does it have to do what the green arrow? That's a judgment. Mine. Does it have to do that? No. But I think you make that bet. And if you're wrong, you're wrong. You get out. But make the bet.
Well, here's the deal. I'm going to make that bet. I'm going to define my risk. I'm going to use options here. And I'm just going to pull up my chart that I was looking at, Carter. So to me, this is a 2-year chart. You could show that it nearly got cut in half, the TLT. It seemed, to your point, yesterday on CNBC, Scott Wapner had Bill Ackman of Pershing Square at 4:00. And he was kind of, again, pounding the table on basically his higher yields trade, right, in the treasuries. And maybe that was the top, too, because we did have that reversal in and around there. So I look at this, if I get a back above, that kind of breakdown level from the 90, we could be in play. Your 150-day moving average is, 150 or so. So to me, I want to look out to December expiration. I want to give myself a little time for this to play. I'm looking at the TLT. It's trading around $89 when I kind of worked up this trade. I want to buy the December 90-98 call spread. I'm paying about $2 for that, buying one of the December 90 calls for about $2.50, selling one of the December 98 calls at about 50 cents. Again, that $2 is my max risk of this trade. Profits up to $6 between 92 and 98 with a max gain of 6 at 98 or higher. I have losses up to 2 between 90 and 92 with a max loss of 2 below $90 on December expiration. This trade idea risks about 2.2% of the ETF price. I have a break even up about 3.3% on December expiration, and I can gain up to about 7% or so if the ETF is up 10% on December expiration. I just like the risk reward here. I'm risking 2 to possibly make 6 if the ETF is up 10% in 2.5 months. Guy, what do you think of these levels? What do you think the risk reward here? Because again, I think Carter, you like looking even at the long term, you like the play for, up 5% in the near term. That would be like a decent sort of snapback. I just want to give myself, Guy, a little time for this thing to play out a little bit.
The levels make sense. I mean, the only thing I would have changed potentially, if you're going to be right, if you're going to be right at 90, you're probably going to be right at 95. So I don't know how much cheaper the 95s would have been. But with that said, you're going to get some leverage in terms of the 90s. So maybe it's worth spending that $2.50, offsetting it by the 50 cents that you sell them. And again, you understand what your risk is, $2. And I think the time frame is right as well in terms of December. So I think it makes sense. And again, if I'm right, Dan, if the market does sell off in a meaningful way, and again, that we'll see how that plays out, you will see a flight to quality in the bond market. Therefore, you will see TLT go markedly higher from here.
Carter, what do you think? I know
think the levels are right. I mean, look, it's very hard to look. We all know that the greatest sin of all, right, is when you have a winner and you don't get as much from it, right? Being wrong is, we're wrong all the time, right? You cut your loss and you control it. What if it goes a lot more, right? And we don't get all that we could. But you got to start somewhere, and I think this is a great place to start, right? The levels and so forth.
Good, thanks. All right, let's look at the dollar. Guy, this is one where you thought, a couple months ago, the bottom fell out in the Dixie, the U.S. dollar index, right? I mean, it was like this really odd move. I think it was kind of the start of the summer or so, but then it just got back on its horse, and it was kind of like in lockstep with yields. Guy, what's your take on the U.S. dollar right now? We know there was a bunch of funky stuff going on in Europe, over the last year and a half or so. We know what's been going on with China and the yuan. We know what's been going on in the yen. You've been talking about it, I think, almost daily for a couple of months now, as Danny Moses, and really focused on that 150 level in the yen. talk to us about the Dixie here near term, and then Carter's going to look at the charts because I mean, it's pretty fascinating, the trends and the breaks of the trend, and I think we have a way to play it if you want to kind of go with Carter's technical view. But I'd love to get your fundamental take here, guys.
So we've thought the dollar could go higher, specifically against the yen, for quite some time. I think it approached 150 dollar yen. I think I thought I saw 149, like 65, 70 print. So that's been working out. Now, if I'm going to stay consistent, which I need to do here, if I do think the market will sell off, and you'll see sort of a flight to quality in bonds, and then, in other words, yields start to go back down, that should be dollar bearish, right? So maybe the dollar will top out here. So if I'm thinking it through correctly, if the flight to quality is in fact in the form of bonds, if yields start going down, you should see a commensurate sell-off with the dollar. So that's how I'm looking at it. Now, other people will say, well, wait a second. If you see a flight to quality in the form of bonds, you actually could also see a flight to quality in the form of a dollar. I totally get it. But in this circumstance, I think the dollar move has been predicated on rising interest rates. And if rates start to go lower, by definition, the dollar should start to go lower.
All right, Carter, your chart on the
Yeah,
Dixie.
I mean, it's so like so there's the theoretical and there's the long term, and sometimes I think it's just about the trade, right? Like for instance, right now I'm in the camp that stocks are going to go lower. People are like, well, if you think the dollar is rolling over and you think rates are coming down, there is no way that the stock market's going to. But it's not that simple, right? So for instance, their relationships are inverse or they're direct. So if it was always perfect, an inverse relationship, with the dollar surging like this, oil should be on its knees.
Mm-hmm.
What happened to that inverse relationship? The point is, sometimes the relationships are inverse, sometimes they're not. And so from my point of view, just the tick, 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 unrelenting higher. What is it, like 14 weeks in a row? I don't know what the count is, but we've all observed that. I just think we're going to fall out of this tight channel. I just think we break down. And so here too, it's about crowding. It's just everyone's on one side all of a sudden. And when that happens, it's usually right to screw up the courage to go the other way. Yeah.
All right. Well, Carter, you got me all fired up to do that with my courage. I'm going to look at the UUP. That's the ETF that tracks, the US dollar. We know about 50% or so about that is the euro here. But again, it's a similar chart. It's showing that fairly steep uptrend. I just drew some levels at that 28.5 level. Carter, this is my chart. Again, not yours. You see that kind of 150-day moving average that's kind of moving towards that level. And that would kind of be my first target here. So again, with the UUP, I wanted to find my risk. I just want to look at the implied volatility of the price of the UUP. This is an index or an ETF. It doesn't move a whole heck of a lot. So you see some very cheap vol here. And also it's interesting because when you look at the options chain, okay, there's dollar strikes. This is again, we're looking at an ETF that's trading around 29.70. So it kind of can be a tough way to play. But again, I want to look out to December expiration. And in this one, I'm really kind of taking a shot here, right? So if I think that this has the potential over the next two and a half months to come back towards that 28.5 level, I'm going to look at the 29 put in December. It only costs about 10 cents with the ETF trading around 29.70. And you might say to yourself, okay, that's a dollar cheap option and it's a vol cheap option. But if I'm going to make money buying a way out of the money strike like the 29 with the ETF trading 29 and the 70, I need a really big move to make money. If I'm targeting 28.5 and I'm buying that 29 put for about 10 cents, I'm risking 10 cents. Ideally, I think the options market is saying there's about a 20% probability that I'm going to be in the money if I buy this 29 put in December. But if I'm targeting 28.5, that should be worth 50 cents. So I'm risking 10 cents to possibly make 40. I like that risk reward. If I think there's a good chance that maybe the options market is pricing too cheap a chance that it goes back towards those levels. So guys, think about that. The risk reward here, Guy, it is way out of the money for all intents and purposes. But if we do get that move back there, it's going to be a nice little trade.
Well, that's it. I mean, it appears way out of the money now, but this has been moving pretty dramatically. And let's go back historically real quick, because again, if I'm being, you got to be consistent. We made an all-time high, I think, in this index back in October of last year, which again lines up with everything that we've talked about in terms of yields and stuff. So if yields were to start to make the move that Carter thinks, the dollar is going to have that commensurate move, because the dollar, in my opinion, has been trading on the back of yield. So the levels make a lot of sense to me. And that 28, which seems out of the money right now, could very quickly become in the money. By the way, I also think you're going to have volatility to start working on your behalf as well, because if this starts to go lower, I think you're going to pick it up on the vol portion of this trade as well.
Yeah, and that's the other point. I think you make it, Guy, if vol starts picking up and it does start moving lower, then maybe you have the opportunity to sell like the December 28 put, make a little bit of a put spread there, lock in that 10 cents or a portion of it, and then play with the house's money. Carter, every once in a while, you and I for 10 years from you and I did options action together with our main man, Mike Coe. And oftentimes, you'd come in and say, I traded some futures, or I bought some out of the money puts here and there, just kind of spreading some chips across the table. How do you think about this? You eyeballed that UUP chart for me and you said, yeah, in the next 2 months, I could see that 28.5. Buying that downside 29 put, does it seem so out of the money to you, or does it seem like something that could be in play?
No, I mean, that's all that would be 29 would take you back to where it was, 6 weeks ago?
Yeah.
Or thereabouts. So that's perfectly reasonable. And it would be a certain give back on not quite a third, but a quarter give back from the low. You need what people always say, well, but what's the catalyst? And why would that? And my quick, not to be pejorative or flippant answer, and this is to the largest portfolio managers in the world, I say, but I'm not in the why business. I'm in the what business, and I don't know why, but guess what? Things always come along. And so why, what was the catalyst? Who knows? What's been the catalyst for going up straight for 14 weeks in a row? Just because rates have, or who knows what, but there is no recession, or everybody else is worse, and the dollar is just a king in the land of the blind, whatever cliche you want to use. Point being, doesn't have to be a why. Sometimes things just reverse.
Yeah, matter of fact. All right. Well, that's how we're going to define our risk. We're going to look down in the US dollar. All right, Guy, crude oil. We've been talking about this is like, to us, I think the energy space is probably another really important determinant of rates, of the dollar, of higher for longer, of all the things you're talking about. And really, could be the thing that kind of weighs on corporate profits, right? Look at that move that we've had in crude oil. You've been pounding the table on it. You've been playing for a move. When it got above that 150 or 200 day, whichever way you look at it, you thought it was going to take a shot, go back towards those 52-week highs. We've had that. Okay. So we've had this massive move in the commodity. You've been talking about the oil services. You've been talking about large integrated oil through the XLE. Give us your fundamental take here. And again, Carter, we made the charts, and we'd love to get you to opine on them. They're not your worth charting, charts here. But Guy, give us the fundamental take and what you think for energy and crude in Q4, and how that might kind of affect U.S. corporate earnings and what it might mean for the S&P 500 in general.
Yeah, it's interesting. So we've thought crude could go higher. Obviously, the move down to 65 sort of flew in the face of that, but now it's back on its horse. And here we are, seemingly on this lower left to upper right trajectory that I think will continue. I also think, you'll get to a level where we start to stall out. With that said, I don't necessarily think that will stop some of these underlying equities that have done really well over this period of time. So crude here is sort of in the sweet spot. I think it can probably grind a little higher, but that's not the prevailing, I think, catalyst for the trade. So I've been looking at the XLE, Dan. I think we have an XLE chart, and I know you're going to outline a trade, but 41% of the XLE is comprised of names that everybody knows, ExxonMobil and Chevron. So almost half of this ETF are those two names. Exxon and Chevron both report around November 3rd. I don't think it's nailed down yet, but it's early November. Let's just put it out there. Morgan Stanley just raised their price target in ExxonMobil to $131. And in both these cases, getting into the fundamentals, valuations, despite the fact that these stocks have moved considerably higher, are still somewhat compelling. So the setup for these things looks interesting. People will say, wait a second, Guy, you're butting against that prior high. And if you go back even farther than that, you will see that this index probably topped out somewhere late in 2014. I get it, but I still think there's some momentum here. So despite the fact, Dan, that the XLE's had a huge run, I still like both Exxon and Chevron. I still think there's some tailwinds for the sector. I think you can be long XLE here.
Yeah, Carter, what are you seeing on our charts, not yours here? Do you see a near-term breakout above this kind of 90-ish level for the XLE? And maybe does it make a move back towards those prior highs from almost a decade ago?
Right, a decade ago. And even further back, if you were to look at like the Russell 3000 energy, I guess from my seat, it's the same trade in oil, the dollar trade, the rate trade, and oil's reversing. You can see that pretty hard here along with rates and to some extent the dollar. I think it's a crowded trade. And so my hunch is that we kind of stay stuck here. In fact, so here's how I would do it. Just, no one wants to sell naked premium, but I do. So I would be selling calls and puts. Why? We're at a former high. We're trying to break out, but we're kind of struggling. And so I think you can get some good premium because there's a lot of bullishness on selling those calls. And really, what would make energy stocks collapse here? They've got so many things as tailwinds, most notably the crude price itself. And so I would sell puts, and I think you could go out 30 days and keep it all. Just stays in the band. Depending on what.
Listen, and that's what makes a market. I mean, the idea of selling a straddle or a strangle and just selling the vol and taking in that premium. If you look at the 30-day implied volatility, the price of options in the XLE, you can see they picked up off of a 52-week low pretty nicely. And again, so it just tells you that there's lots of players really interested in the same. And just look at the vol. I mean, it's higher than the S&P vol considerably here. So that makes some sense. Listen, I'm not as bullish in these names by any means as Guy. And he's had the trade. And so I think at this point, if you're playing for that near-term breakout and a move back towards the 10-year highs, I think you define your risk. And so rather than just buying an outright call, if you're bullish, I think the idea of buying a call spread makes some sense because you're going to take in some of that out of the money sort of premium. So if you're in Guy's camp and you think that the catalyst exists for Chevron and Exxon to break out, and that's going to draw the XLE higher, I think you look to a kind of near dated out of the money call spread here. So when the XLE was trading about 91 or so, you could buy the November 95 100 call spread, paying about $1 for that, buying one of the November 95 calls about $1.50, selling one of the November 100 calls about 50 cents. Again, that $1 is your max risk of this. You're risking, up about 1% of the underlying ETF price. It has a break even up 5.5%. That does seem out of the money. But again, if there's a reason for these things to get going, you're going to probably be near that pretty quickly. You make up to 4.5% of the ETF price if it's up 10% between now on November expiration here. So the options market is suggesting about a 15% chance of a maximum gain of this trade. That doesn't seem great, but again, we have some catalysts, we have some momentum, we have a commodity that's moving around a lot. Guy, does that make sense to you? Like, again, Carter's not in that camp. It's not something that I'm kind of pounding the table, but I like the risk reward of buying a 95 100 call spread if you think that this thing's going to continue into mid-November.
Yeah, look, it's a bit of a flyer. Clearly, you got this this time that you put out there encompasses the earnings release of both Exxon and Chevron. So you have that working for you as well. Again, I don't think crude necessarily has to move all that much for these things to continue higher. I do think the energy trade can continue higher in the face of a broader market that I think might sell off. So I understand why people would be reticent here given the run. I just think there's some more. I think there's some more tailwinds to the space.
All right. Well, listen, we wanted to get on here on a Friday afternoon. We thought it was a really interesting setup into the Q3 end here, and especially on 3 risk assets that we think are going to determine a lot of the potential movement in the S&P between now and year end. So thank you, Carter Braxton Worth, for coming on with us on a Friday afternoon. Guy Adami doing yeoman's work here. We will update these trade ideas on Market Call. Definitely, you guys know where to ping Amanda at contact@riskreversal.com. And also, guys, give her a shout out. It's her birthday tomorrow. I'm not going to tell you, I'm not going to dox her guy or whatever and say how old she is or anything like that.
I'll say it.
Amanda's been doing amazing work for us, and we really appreciate our whole team putting all this stuff together, and Carter Braxton Worth and Kim over there at Worth Charting for doing the work that they do. So thank you guys on a Friday afternoon. Thanks to FactSet, financial data and analytics guy, powered by what?
Hopefully tomorrow being Saturday. So maybe they're powered by, Monday, but you get it.
Well, they're powered by the Diaz birthday vibe. So thank you guys for all being
See ya.
here, and we'll see you all on Monday. Guy and I are going to be on the radio for Market Call In at noon. 844-942-7866. Call into Sirius XM Business Channel 132 between noon and 1 o'clock, and we'll take your calls. Thanks, everyone.